Good morning. This is Jim Colburn of Commodity Research Group. I'm with Andy Lebow, also of Commodity Research Group, and we're here to talk about energy markets. To learn more about us, you can check out our website, commodityresearchgroup.com, where we post our podcasts and our blog. We would like to thank our friends at EKT Interactive Oil and Gas Training for hosting this podcast. Check out their newsletters, podcasts, and learning modules at ektinteractive.com. This podcast should be construed as market commentary, merely observing economic, political, and market conditions, and is not intended to refer to or endorse any particular trading system, strategy, or recommendation. We are not responsible for trading decisions taken by anyone. Information is not guaranteed to be accurate. This is not an offer to buy or sell any derivative. Today is June 10th. And Andy, we've had from a chaotic week back in April, in which we saw negative prices. We saw negative strike prices trade. We saw the U.S. oil ETF roll out of June. And now we've touched $40 oil. What happened?
Well, I think the real question, Jim, is what didn't happen. It's been a remarkable couple of months in the oil markets, and I guess the only thing we're missing really is a big geopolitical upset. But you know what, Jim? We still have 6 months to go in 2020, which may be proving the most eventful year we've had maybe since, 1968, something like that. But in any event, in the, certainly when we did our last podcast, the market was, as you mentioned, was in disarray. We were still in the midst of a price war, we're still worried about COVID. And we were, at that time, in the middle of what IEA Executive Director Birol has called Black April, and the markets reflected that. We had big contangos. We went negative. Brent went to multi-year lows. So what happened since then? And certainly on the supply side, OPEC and OPEC Plus did get their act together. The Saudis and the Russians did get their act together. And not only did they get their act together, but they've cut production. Their number was 9.7, and they probably got close to 8.7, 8.8, maybe even 9 million barrels a day of cut, which the market was actually pretty cynical that they'd be able to get those numbers to anywhere close to the 9.7. And then we had big production cuts from non-OPEC producers, the U.S. and Canada leading the way. So as a result, on the supply side, massive cuts in May and into June. And certainly on the demand side, as the lockdown ended globally, or you're moving into phase 1, phase 2, red, yellow, green, whatever you want to use, obviously demand improved. And as a result, the massive stock builds have abated. And the market rallied into that. I think that what's surprising, at least to me, was, and I'm sure to many other analysts and traders who may now say, oh, yeah, I saw that. I think what was surprising was the rapidity of the rally, Jim. I think many of us were probably bullish for third or fourth quarter. I know
Right.
I was thinking, okay, maybe WTI can get into the 40s sometime in the fourth quarter. And here we are, 1 month later, or weeks later, and we're up to $40.
I know we're going to get into the EIA's short-term energy outlook that came out yesterday, but one of their comments in that report was that they expect June inventories to draw by 1.9 million a day, and a month ago they had June as building 1.6 million barrels a day. So they kind of thought the draws would come in starting in July, and now they're pushing it up to June. So I think it caught a lot of people by surprise. And one of the things we picked up on our blog was that the spread option guys were liquidating puts, so you could see large volumes of trades going through and open interest going down on the puts, and then you saw some calls. But this would be buying. There was actually I can't remember whether plus 25 call strips going. So people were actually not only saying, the worst is over, but they're saying there's a chance we go backward dated in June, July, and I guess we did for a little while, right?
Right. Yeah, it snuck into backwardation, which is a whole nother story to itself. The other thing that we saw was just a tremendous amount of speculative buying. You look at the commitment of traders, and the net length has just exploded in the last 8 weeks. It's up over 200,000 lots of new net length on the money manager side. So the specs were, I guess the specs were catching it.
Yeah.
Maybe not so much all the all the Wall Street analysts. They might have not they might not have been cat. We've built 240,000 of net length in the last 8 weeks, as apparent as according to the commitment of traders. So they've been on board for this rally.
Yeah, it's interesting. We did have a couple of our oil guy friends that were, their barrel counters, and they picked up on the rapidity of the cutback in the Cushing, not Cushing area, in the all the areas of the U.S. production declining. Like they were getting, maybe it was anecdotal, but they were catching that, this stuff. Production is declining faster than anyone thought, and part of that wasn't by choice. They just had nowhere to put it.
Right.
So, in OPEC too, they look like they're doing a great job cutting back, but there was no demand out there to put barrels, so it was probably one of their easier calls to cut back more. And getting back to that EIA report, they have inventories drawing 2.5 million per day from June to the end of 2021, and we're going to get into the difficulty of forecasting these numbers in this kind of environment, but that's kind of a bullish look to me. I mean, that to me says that some of this is built into the market, but there's a lot more to go should that unfold the way they think it might.
Yeah, I think they're saying 2.5 million barrels a day from now until the end of 2021, which is, yeah, I don't know about that, Jim.
Yeah.
They just take a number. It's sort of like just pick a number. But our own numbers, I think June is going to be like balanced to a slight draw, and then I think third quarter, we're probably going to see close to 2 million barrels a day draw. But you're dealing with some, on both sides, both the supply and the demand side. It's really difficult to forecast. The supply, which is usually a little bit easier. We've got a lot of moving parts on OPEC side. We know that Kuwait, the UAE, and Saudi are going to increase production in July. Libya, I don't know.
Yeah.
And Iraq, Nigeria, they're promising that they're going to cut back. Iraq was given almost a very tough task, and I doubt they'll ever comply 100%, because they're 500 to 600,000 barrels a day away from that. Russia's going to increase production. From the non-OPEC side, Russia's going to increase production, no doubt.
Right.
In beginning in August, and so those numbers are going to be difficult to forecast. The U.S. numbers are, proving to be very difficult to forecast. as are the Canada is definitely going to increase production. I think they're already on the way to increasing production.
Yeah, they're all these are moving targets and lots of moving parts, and it's very very hard to you know get a you use a big standard deviation around that any number that you put out, and it's just a number to work off of. It's almost like what some of these guys call scenarios. Here's the scenario we're working with, and we know it's not going to be right, but we have to work with something. So
right. And I
yeah.
think that's what the EIA did with the 2.5 million. I know that's what I'm doing with this with my balances. They change all the time.
Yeah, so I was looking at the EIA numbers yesterday, and they have a piece they call like the notable forecast changes from the previous month, and they use GDP estimates from IHS Market, and so for the U.S. they were looking at for the year a decline of 7.4% in GDP, and that was -2 from the May forecast. So they're looking. So that GDP forecast went down, and I'm pretty sure it doesn't include, Friday's non-farm payroll and last week's unemployment data. Which, if you look at just the sort of the mathematical models, no judgment calls that the Atlanta Fed and New York Fed use, that would be it. They increased their estimates for Q2 by 5 to 10 GDP full points. So
Wow.
so already the numbers they're using could be, if they use an updated GDP forecast, maybe they're even more bullish than, maybe more of a draw. It would be their numbers. But anyway, it again is what you said. It's very, very difficult. These are
right. And I was just, I was talking about the supply side. The demand side. Talk about trying to come up with what you can only come up with what you think. Use your best estimates. Like you said, you look at 5 to 10 GDP points. That's huge, Jim. So
yes.
that's half. That's let's see. That's a million, a million and a half barrels a day, maybe more.
Swing.
On the demand side, yeah, on a swing. So I think you could look at some of them, what the markets are telling you, and certainly demand has improved dramatically from April. That's obvious, but margins are really not that good, and in fact they're pretty poor. Because this rally in crude has been so swift, products have not kept up with it.
Mm-hmm.
by any means. That we're seeing. The margins are getting a little bit better in the last week or two, maybe in the last week, but they're still well below where they were for like a year average, or even over the last 15-day average. They're poor.
Yeah, I was going to ask you where you want to go next, but having brought up margins, can you talk about specifically what's been going on with distillate? I mean, it looks like we're building stocks. That distillate was the one that was going to perform well, and it looks like we're making a lot.
So ironic. I mean, we were talking about IMO 2020.
Yeah.
That was going to be the big event.
Yeah.
Of 2020 for diesel, IMO 2020, and it's now you barely even that barely even scratches the surface. But distillate stocks have built globally, refined, and that's a function of the poor demand for jet fuel. And on jet fuel, we came really close and running into containment problems in April. At the airports when people just stopped flying, and refiners had to, go to Plan B, which was try to blend their jet into diesel, into distillates, and produce more distillate and less jet. And demand for diesel has been pretty poor It was good in March, terrible in April, improving in May. It's getting a little bit better, but we've built like right now, total U.S. distillate stocks are 176 million barrels, which is you have to go back into like the 1980s and the late 70s to get numbers that big.
Wow.
Yeah, and days supply, which is stocks over demand, is 54 days. The 4-year average is 33 days. So
Oof.
we are like way oversupplied with distillate. Now, that's regional because I just Chicago ULSD. I think it went backwardated today.
Ah,
So there's like diesel everywhere. Water everywhere,
yeah.
but nothing to drink. The
Yeah.
Midwest is a little bit tight on diesel, but Europe is long diesel. Asia is a little bit long diesel. So that's a big problem. That's a big problem because we can't keep making. Diesel yields are beginning to come down, but refiners have to be real careful on diesel. So that has led to that's been a big drag on margins. Gasoline is inventories right now are 259 million, and that's the 4-year average is 236. Days supply are 35. The 4-year average is 25, so that's 10 days supply too high. But gasoline demand's beginning to come back.
Hmm.
It's not going to be where it was in 2019 for a long time, I think, Jim.
Yeah.
Um,
I see the EIA says we're going to grow demand in 2021, but it's still going to be, I think, a million barrels under 2019. That would be world, total demand. So yeah, we're going to come back, but not to where we were.
right, right.
Yeah.
Hey, we
See,
may never come back to where we were in the U.S. on at 20. I don't want to say never, but it may, that may be a high watermark for a while. Certainly, I think you look at the unemployment numbers, even though they were better in May, there's still tens of millions of people that are unemployed and won't be unfortunately won't be driving to their jobs. And
yeah,
whether Americans take, at least in the U.S., whether they take big road trips this year, that's another question. What's the road trip? What's the summer going to look like?
yeah. I hear that anecdotally that people will not be flying; they'll be driving to places, and now that many have been able to work away from their office, they might set up an office in an Airbnb someplace. So I would expect that kind of demand. But then, like you always say, there's not enough people working that still drive. We live in the New York area, and there's a lot of mass transit to commuters, and so but the rest of the country, most people drive to work.
And again, what are those drives? What are those Airbnb drives going to look like? Is
Right?
it going to
Yes.
be, is it going to be just within 5 hours or something like that? Or are
Yeah.
you going to see those big, national park road trips? Maybe,
Maybe.
man, maybe. But I think the big problem is on the employment side. That's going to be an issue on gasoline demand.
Yeah, I'll just take a little move into my world, Andy. We've seen the option market. I always look for stuff to kind of look at what people are trying to do in the marketplace to confirm what we're reading and what we're talking about. In March, we had if you look at the regular WTI, they call them LO options, 200 almost 205,000 traded per day. In April, 156,000 traded per day. And obviously, March was a big OPEC meeting that fell apart. April was the minus prices and the famous. We had a couple of minus strikes trade, not very many, maybe a handful. We had a zero strike put trade, and I like to say that somebody bought that put for the right to sell something for nothing. And then in May, we dropped down to 87, almost 88,000 contracts. So really a measly trading month of May. And the CSO markets, the spread options followed that as well. They're kind of not, maybe the last couple of days they picked up because of the OPEC meeting. But yeah, there's no really, I thought for a while maybe the direction was people buying puts, but it doesn't look like that's, it doesn't look like there's a trend in what the people are trying to do. And then volatility, of course, was, over 200%. It's using a Black-Scholes model, which blew up once again, and now it's down into the 50s. So it's still, on the high side relative to a long-term average, but much, 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 much lower than what it was during the craziness back in March and April. What do you think is, given what's happened in the market and given what you have been, your numbers and what you're reading other numbers, what do you say, how much of this is in the market now? Is the market overbought now? Has it got more to run?
I think it could be a little overbought, but I don't, it doesn't look like, if we're thinking about stock draws, granted, it's stock draws from a huge oversupply. I mean, the oversupply is probably, could be as much as 1 billion barrels relative to where we normally are this time of year. But if we're talking about stock draws into July and August and maybe into September, the EIA, as you said, they're talking about it through 2021. But it seems like 2021 is, that's a whole nother chapter, right?
Yeah. Oh yeah.
Let's just try to get through 2020.
2021 is more about what Fauci's saying than what the EIA is saying.
Right.
Yeah.
Exactly.
Yeah.
That's a long way away, 2021. But in any event,
let's get through tomorrow. Today.
I think if the balances do look like there's stock draws, I don't really see the market really giving way, like it did earlier in the year. So, I think it's going to be steady, possibly higher. The problem is you're fighting all this inventory is going to come out, and the floating storage is going to come out. Brent, we're seeing that begin to weaken again. The structure, anyway, is what I'm talking on Brent. So, maybe the market has some legs over 40, but could it get to 50? That's going to be a really hard. I think that's going to be a really hard task, Jim.
Yeah.
To get WTI, up to 50. Can it get 42 to 45 if everything breaks right? And demand continues to improve, and these production declines are in the U.S. Continue. Yeah, I think that's not completely out of the realm.
So you're not using a minus 40 plus 40 range.
Well, I would like to use minus 40 plus 40, but I don't think that's realistic. And we haven't really spoken about U.S. production or the
right.
these crazy weekly reports.
Well, let's talk about the weekly that just came out this morning, because I thought what was interesting was the demand side, total or product supplied was up 2.5 million, and there's problem. I mean, there's problem with estimates, but there's problems with these numbers as well.
Yeah, a lot. The one thing about these weeklies, and we usually have said during the course of these podcasts, you really have to look at 4-week averages, and you have to understand that a lot of these, they're models, and the one number that really people focus on week in and week out, that's a model, is crude production. Crude production has come off from 13.1 on a weekly basis to 11.1, so it's 2 billion barrels a day. We think, we don't find out really until the EIA has done a look back when the petroleum supply monthly comes out 2 months later. So we won't know for sure. And that's clearly a big problem. The other big problem is that they've got this number, the adjustment factor, or the fudge factor. It's running like 1 million barrels a day for a 4-week average.
They actually call it the adjustment factor.
The adjustment factor, right, down, and 1 million barrels a day on that's 28 million barrels. What is that? Is that what I know what it is? It's it's where when things don't balance, they call an adjustment, and if it's off production, that's really bullish. That means that production is a lot lower than what they're reporting. If it's off exports, probably less so, or imports less so. But that's a big number.
So that number, you're saying the 4-week average is 1 million. What typically we've seen it 1 million in the past, but not sustained. Is that true?
Not sustained. I mean, we've seen it like 700,000 barrels a day. Yeah. I mean, even on the, when you go back to the petroleum supply monthly, there is an adjustment. There is an adjustment number. So typically they'll, it's the adjustment factor is adjusted lower. It's not that as outrageous as what it appears.
Right. What numbers are, I don't want to say can you count on, but what
the stock numbers you can, those you can count on. The imports are they've done a little bit better job on import numbers. Apparent disappearance is that's a formula, so that's not real. And what am I missing? I mean, the stock number, as I said, the stock numbers are probably pretty good.
Yeah, there's actually a draw in Cushing this week to 2.3 million barrels to 49.4, which is below last year's number. And
I mean, Cushing actually the 4-week it's 49.4, and it's the 4-year average is 55. So we're below. For all the hand wringing, including mine, about Cushing reaching tank tops, we're below normal on Cushing.
It's unbelievable because we runs are way down from year to year, and it's supply, right? I mean, it's just the production. I mean,
it's production. The other thing that is pretty important is that the crude stocks don't include the SPR rental barrels.
Right.
And so you got to add like 15 million. I think it was 20 or 22 was the total. So actually, crude stocks are you look at 538, but because right now there's 15 million being stored in SPR, in which the companies storing it are paying the government just the rental fee.
Right.
And those barrels will almost certainly come out. The earliest they can come out, I believe, is September. So, there's another, there's another 20 million barrels actually in the domestic supply, which makes it look even more dire, actually.
Right. Yeah, I saw that there was a little more than 2 million barrels put into the SPR, and those are probably rental barrels, not.
No, they're all rental barrels.
Yeah.
Not all. I mean, the 15 million
of the change
rental.
Yes.
So it's all gonna, it's all gonna come out.
Andy, the U.S. oil production, I guess the EIA talks about a 6-month lag from the change in price to actual movement in production. It's a little quicker this time, but what they're looking for a decline to 10.6 million by March of 2021.
Right.
Yeah.
Right. So we're at 11.1 according to the weekly, which, as we said, is a modeled number.
But we're already starting to hear sprinkling of stories that they're starting to frack again looking at increasing in the Permian. Is that
sure? That definitely makes sense. Whether or not those increases are going to be enough to counterbalance the depletion, that's another matter. It may arrest. Certainly the rate of decline is going to be a lot lower than it's been. If we're looking at 2 million barrels a day since March, the rate of decline for the rest of the year should be, we think, less, and what the EIA is saying, less than, what we've seen so far. But the rig count, is down to 206 from, I think that's down 600 in the last year, maybe more than that. And certainly we know that you've got to drill and produce new wells, have new wells produce in order to make up for how quickly some of the legacy wells decline. So depletion's a big issue, but we do have a pretty big inventory of DUCs drilled but uncompleted wells that will probably come on first. And then I think drilling will pick up, as prices pick up naturally.
Right.
So what's the real number going to be, Jim? That's a big question. I think there are some analysts, who are looking for production to go down to 10, either at some 10.0 by the first quarter.
And they could be right.
They could be right, or as we've learned in the past, one thing we know from, U.S. frackers is that they're pretty good at what they do.
Yes.
Way too good at what they do. And there's certainly, what I would think is we're going to see consolidation in the industry. And, there's definitely going to be more efficient operators with a bigger balance sheet taking over some of this acreage, and they'll be able to continue to drive the costs down. So, it might go down to 10, and maybe, I think that's a little low, but we could see, we could see a pretty strong recovery as well.
So, Andy, before we wrap this up, are there there's so many eye-popping, jaw-dropping numbers that are coming out, whether you're following energy or the macro economy, but is there anything that stands out to you and you just say, this is unbelievable? Or is it just one after another?
I think it's like a greatest hits, Jim. It's just one, it's just like one, it's one after the other. I look at almost any of these numbers and it's like, oh my God, like distillate stocks at 176 million. Are you kidding me? Or the price, right? The two of us in April were just, we couldn't believe it.
Yeah.
That it went negative. I didn't think it was going to go below 975, and it went to minus 40.
Right. Yeah. Well, that's right. That was probably one of the biggest, and I keep mentioning, for me, it was the zero struck price people pay. I think it traded out to $4. I said, wow. The Black-Scholes model has always had problems with it. That's, if you think about an option market having a skew where some options that are trading off the same futures price have different implied volatilities, that's telling you that the model is, it's not reflecting what's going on in real life. So that shouldn't happen. So it's, and then when you think about, the extreme, like at expiration, a lot of these measures blow up, like the gamma, stuff like that. But this was a case where the underlying assumption of no negative prices kind of blew up, and all the puts just exploded in value out of the money puts. So that was kind of interesting. We did, like I said, we did see some minus strikes trade, but it was only a handful and not for much volume. So that was kind of like, I guess, another lottery ticket type thing. But it was at zero. When I saw that zero struck put trade, I was like, wow, we've never seen it before. And we're old guys. We've been watching this market for a long time, since the 80s.
Yeah.
And it takes a lot for old guys to say this is the most amazing thing we've seen.
Right. I mean, when we're talking about, when the IEA is talking about demand being down 30% in April, that's 30 million barrels a day.
Yeah.
I mean, it's mind blowing.
Yeah.
Just mind blowing. And of course, at the same time, the Saudis and Russians had increased production. April was definitely one for the books.
Yep, one of those months with R in it to stay away from.
Yeah.
Yep. Okay, well, let's wrap it up. Andy, anything else you want to add? We can finish it right here.
Well, if you want to get a hold of us, try me at Lebow at commodityresearch.com. That's Lebow at commodityresearch.com. Check our website out. Jim posts a lot of great stuff just about every day, and it's always interesting and provocative stuff on there. I definitely urge you to go to our website.
Yes, so we'll be posting this podcast on the website, and then we also we put some stuff on LinkedIn as well. So, Andy, you'll be putting this podcast up on your LinkedIn site as also.
Definitely. And
we'll see you all next week. This is Commodity
next month.
Sorry, next month.
Maybe next week. Maybe we'll do another one.
Yeah. This is commodityresearchgroup.com.